Fair value is such an important topic for any organization which has financial instruments and also commodity inventory and cryptocurrencies on its balance sheet. Now, for IFRS, it's IFRS 13. Under US GAAP, it's ASC 20. And they're the accounting standards which define fair value. Now, we refer to IFRS 13 or ASC 20 when another accounting standard requires or permits fair value measurements or disclosures about fair value. So how do we define it? Well, fair value is defined as the price that would be received to sell your asset or paid to transfer your liability in an orderly transaction between market participants at the measurement date. Now, the market lingo or the market term for fair value is the exit price. So in this illustration here, we have both debt and we have securities, a corporate bond. We need to go to the market to find out how much the market is willing to pay for our bond and how much they're willing to accept to incur our liability. Fair value is not usually reflected in the end-of-day prices used to revalue our trading portfolios. And this is because a number of adjustments need to be made to that revaluation price in order to arrive at fair value. And if you'd like to learn more about these adjustments, we look at them in the valuation control module of the product control training syllabus. So let's now explore the definition of fair value in more detail. The accounting standard wants firms to use the price within the bid-offer spread, which most reflects fair value. Now, usually, not always, but usually our risk management systems are going to be consuming mid-market prices to revalue our portfolios. So whilst the standard doesn't prohibit us from using mid-market prices as fair value, usually only market makers who are quoting both bids and offers who don't have to cross the bid-offer spread. So banks will typically use bid prices to fair value assets, i.e. what somebody's willing to pay you to take your position. In this screenshot here from Bloomberg, that would be like saying the fair value of our long zinc position down the bottom is worth $2,620 per ton. Now, for liabilities or short positions, the banks will use the ask or the offer price to arrive at fair value. So in the case of the zinc example, they would be willing to receive $2,621. Topic number 2 around fair value definition is valuation technique. Now, this is quite an obvious point, I think, but when you aren't taking a direct price from the market to value your asset or liability, and instead using a financial model or valuation technique, the standard requires firms to approach pricing from the perspective of market participants. Now, you need to make use of pricing inputs which you can observe in the market, so it means you can see them, they're being published somewhere, and minimize the use of pricing inputs which aren't published anywhere, so they're unobservable. Okay, number 3, orderly transaction. So fair value is based on an orderly transaction at the measurement date. Now, why is this important? Well, if there is a market participant having to execute forced transactions, for example, Lehman Brothers failed because they ran out of cash. Nobody was willing to lend to them because they'd taken excessive subprime mortgage risk. So if, say, because they needed to raise cash quickly to survive, they decided to sell their entire bond inventory at any price, no discount was too big to accept. These were essentially forced sales that would not have to be a reference point for other firms when determining the fair value of their positions. Number 4, with a market participant. Now, the source of your fair value should be from the market. It shouldn't be from a related entity. So, for example, the New York office of Citi shouldn't be asking or relying on a price from the Citi London office for prices to fair value its trading portfolios. Number 5, the measurement date. For trader mark positions, one of the challenges has been to get the trader to mark to the market, even if they have no intention of exiting their position soon. When it comes to the accounting standards, they're agnostic towards intention and require firms to align valuations to fair value for every measurement date. Now, number 6, blockage factor. Now, this point talks about an asset's features rather than the firm's features. So this may include, for example, the condition or location of the asset, any restrictions on the sale or use of the asset. But what we aren't required to consider is entity-specific factors like oversized positions. The accounting standard sees this as a firm-specific factor and not an asset or a liability factor. And so therefore, you only have to source a price, an exit price, for the normal market parcel. Now that we've explored the definition of fair value, let's look at the unit of account. The default unit of account for fair value measurement is the individual asset or liability. However, there is a condition which benefits trading desks, and that is you can elect to measure a group of assets and liabilities if your firm manages and reports risk on a net basis, and the group is measured at fair value on a recurring basis. So the question becomes, what can we group? Well, we can only group risk which is substantially the same. So the risk has to be substantially the same, but it doesn't have to be identical. For example, on the bottom left-hand side here, we have a US dollar asset with an exposure to the secured overnight financing rate, the US dollar interest rate index, with a DV01 or interest rate sensitivity of $100,000. So that means for every 1 basis point increase in SOFR, the desk makes $100,000. Below that, we also have a US dollar liability with a minus $50,000 DV01 exposure to SOFR. So in this case, we would be able to combine or group both risks because they are substantially the same, because they reduce the US dollar SOFR interest rate risk for the firm. Now, on the right-hand side, we have the same asset, so the US dollar SOFR asset exposure, but this time we have a Euro FX exposure as a liability. So in this case, the interest rate risk associated with the financial assets cannot be combined with the FX risk from the financial liability, as the combination of the two items would neither reduce the interest rate risk nor the FX risk. So we can't combine these two. So now that we know what fair value is and what unit of account is applicable, we now need to determine which market to source the price or fair value from. The default market we are to source our fair value from is the principal market. Now, the principal market is the market with the highest volume and the highest activity for our asset or our liability. Now, if your entity doesn't have access to the principal market on the measurement date for whatever reason, then you have to go and identify the most advantageous market. Well, the most advantageous market maximizes the amount received to sell the asset, or is the minimum amount paid to transfer a liability. So these prices, when you're identifying the most advantageous market, the prices that you're considering will have to include transaction costs, and if relevant, if it's a physical good, transportation costs. Now, once you find the most advantageous market, need to note that the fair value is not adjusted for transaction costs. If it's a physical good you need to take to the market, then transportation costs is probably going to be appropriate. But transaction costs, we do not factor into the fair value of our asset or our liability. If you'd like to learn more about what are the typical valuation adjustments which we need to make in order to align our portfolios to fair value, then I suggest you go and check out Valuation Control module, the Valuation Control module.